Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, April 6, 2016. Starting this video, it's actually 12:20 Eastern Time, my time here. And I posted a little while ago, posted shorting the Biotechs in the trading room. Personally, it's not an official trade idea, just something I'm doing, throwing it out there. And I will do an update on the charts. I posted that shorting the biotechs right here around 56.50. And at the time, they were still pushing up and right at making new highs. And, I mentioned, and I often talk about this on the site, I have a handful of terms I've made up and use. And one of those is I often have a what I call an anticipatory trading style, meaning I anticipate moves before they happen, where 99+% traders wait for technical evidence of a reversal. So, I throw that out there, and those type of trades, sometimes I'll post them officially if there's a pretty, if my opinion's pretty strong. And at this point, as I mentioned, I'm doing two things with this trade. Number one, I took day trade size position, which means an oversized position, which I'll close most certainly a good part of, if not all of it, by the close. So far the biotechs from that point have had a nice pullback. I used the leveraged 3-time ETFs, shorting in some margin accounts, so that's about a 3% gain so far, and going long the other one, the LABD, in a couple cash accounts, IRAs. So I might hold for a couple days, or I might even take those positions off today. Normally, I start with the long-term charts and work my way in. I'm usually a top-down. I take a top-down approach to investing. I look at the longer-term charts to formulate the bigger picture, and then work my way down to the daily and often intraday charts in order to hone my entries and exits. And this time we're going to do this a little different. We're going to work backwards. We'll revisit this chart. I just wanted to point out there's XBI, and as I mentioned, this is what happens is you have these usual quick reversals. When XBI is up, the biotechs were up 5% or so at that time, or above 5%. I've traded these sectors for years. That's the high end of a range, and so my risk on the downside, in other words, they're not going to go up another 5% today, not a whole sector, very unlikely. So, had they done so, I would have stopped out, not too much above. But so far, so good, and probably when I'm finished with this video, I'll lower my stops. There's a couple levels here. There's support level here. Probably get a little reaction. But as I mentioned, I shorted a good deal of LABU, which I very well may tuck away a portion of that for a longer-term swing trade, especially if the charts continue to develop. So that's that. We'll revisit this chart. You can see the negative divergence, the rising wedge, and all that. It wasn't completely arbitrary that I just threw a dart and said, okay, I'm going to short these stocks because they're ripping and they're at their daily highs. There was a reason behind that, and more so on the longer-term charts. Let's go ahead and zoom out. I'm using XBI right now. We'll look at some of the other ETFs. There's three main biotech ETFs, at least that I'm aware of, the one times: XBI, PBE, and IBB. So I like to look at them all, but when trading LABU and LABD, they track the SPDR's S&P biotech sector, as does XBI. So this is really the one time, and you don't want to use the charts of the leverage ETFs. That just the decay renders an inaccurate technical picture. So you want to use a one time when charting, even if you're going to trade the 3-time ETFs. At least that's my strong opinion. So what was I referring to in the trading room about levels coming up? Well, this is one right here. These lines have been on my charts for quite some time. This one you can see was created back in October 2nd, 2015, and it looks like I updated in January 20th. So that's a level I've had for a long time on XBI, and you can see it just clips these recent levels here. This is why that line was added. You have some nice reactions back. We had this initial thrust down, and this was the bounce. We broke out of there to the upside, bounced, and so I consider that a pretty significant resistance level. And that was, among other things, one of the reasons for calling a top on the biotechs. We're trying to call a top. We'll see if that happens. Position's not profitable, at least in my opinion, until you close it out and book those gains. So far, so good, and I'll watch this, and I'll be concerned if there's a 60-minute close above this line. So that's XBI. That's a 2-hour time frame. That was a 60-minute time frame. This is a 2-hour time frame. this shows, as we'll look at on the daily, I highlighted a few weeks ago an update in the biotech sector, and in my opinion, this action, when viewed out on the longer term time frames, meaning the weekly charts, is very typical of a bear flag. Not so much here on the daily charts, but or this 2-hour chart, but yes, on the weekly charts. And if you're new to the site, you can reference the post. This is when I was bullish on the biotechs and long back here when we had these divergences. I just, my nothing's 100%, but I've maintained all along, and I continue to believe that this is a bear market rally. And if so, I was very fine and, quite happy to, be going long at this point over here when we had these bullish divergences on the 2-hour chart and 60-minute charts, and catch that initial bounce up. But at this point, if I am correct, and this is a bear market rally, then I view this as picking up nickels in front of a steamroller. So I don't want to be, the last guy long at the party when the music stops, if indeed that's what's about to happen. So there's XBI. We'll take a look at a couple others here. As I mentioned, we have IBB. It's the NASDAQ. iShares NASDAQ Biotech ETF fund. You can just make it out here. The writing and the symbols right there. So this one looks, it's in what I call technical no man's land. This was a key resistance level here. You see numerous reactions. Here's that base that IBB put in. And so this, I know Schooner in the trading room, he's caught a lot of this move up. He's been bullish, and I fully recognize that as a breakout. So we've broken above there. And I'm not going to try to force any resistance lines. I could put a minor resistance level there, but this is the next key resistance on IBB. But again, IBB is one of 3 individual biotech sector ETFs, so a little more possibly a little more upside in IBB. And then we have PBE, which is the PowerShares Dynamic Biotech Portfolio ETF. And there's that similar to XBI. We had that, and this is really nice. Let's zoom in here and you can see why I have this resistance level, which we're just shy of right now. Let's try to focus. If I can zoom in on this chart, give me 1 second here. Yeah, here we go. Here we go. All right, look at these reactions. 1, 2, barely, a little bit. And this is a 60-minute chart, so we just spiked above it, and then another reaction from below, another reaction, several candlesticks actually there. That, in my book, the more reactions off a trend line, the more significant that level is. So there's a pretty nice, trend line there, significant resistance. So I view shorting a near-term extended rip. This isn't long-term oversold or overextended because we based for a while. I mean, certainly if the market's going on to new highs, the biotechs could bust through there and explode and run for quite a while. That's the nature of this beast. I mean, I like to trade beta. I like to trade volatility, and that's why I'm looking at the biotechs. But you got to be careful with this sector or any volatile sector. Time your entries. And you don't want to be caught in this noise. This was a grind, chop sideways, tough to make money unless you were very quick, able to trade these rips that only lasted a day or so. And so anyways, that's that. We have, like I said, resistance not too far overhead. And let's take a look at 2-hour chart. I don't see a lot there. Let's see if I had anything on IBB. Yep, same story. We broke out, and there's the next. Here's another key resistance level. I don't know if I covered this one on the 60-minute chart, but that's a 2-hour chart right here. And again, back in January and February, I was short going into, short the biotechs right off the highs back in 2015, both personally and officially on the site. Closed that out somewhere in here. The LABU short. We shorted the 3-time ETF, as well as I had some individual names I had put up. But this was just a beautiful divergent low back here, and that was the time, in my opinion, to go long the biotechs. And obviously you could have stayed long at this point or gone long here recently if you saw a reason. As I said, Schooner did, and they've broken out. So they've broken out above this base, which by all accounts, is bullish on face value. But I'm going to get into the longer term charts and tell you why I'm personally taking the other side of this trade right now. Okay, I've jumped out to the daily chart on IBB here. Quite busy. I apologize for this. I usually try to clean these charts up when I post them in static form or for videos, but there's just a lot. These are all significant lines. Most of those really don't matter anymore. These were levels I was watching before. You like, for example, you see this uptrend line, you see a breakdown and a high level back test, and then prices roll over, broadening wedge pattern, everything else. Here's a sort of a wedge pattern here, trend line break. So again, they're all significant, but right now let's just focus on what I'll point out here. I have this yellow line from the recent lows right here. I just dragged it to get out of the way up to this previous reaction high here. That's a Fibonacci retracement. So if you look on the chart, you see the dotted yellow lines. Look to the left over here all the way. These are the fib levels. So we have the 38.2, the 50%, and the 61.8 retracement. And so far we're failing right at, we punched a little above it, but seem to be stopping right around that 38.2 fib. So that is, a lot of traders use fibs. There's also some horizontal resistance there. Let's see if we go here. Let's go back to September and October. You see these reaction highs here at this point. So I put a horizontal line which happens to perfectly overlap that Fibonacci retracement level there off that, this big move down. And so that's resistance. The blue line is just marking previous fibs. Don't disregard that. It's not, well, actually, you know what? On second thought, let's count that, because that line was placed there. Here, I'll color this line. Let's give it a bright color just to stand out. Okay, it's a red line. I'm going to put it right on that those lows. So what that does, it catches these reaction lows right here back in November. It catches that key reaction low right there when we had that big meltdown back in August. And we were, if I recall, we were already short at that time officially on the site, caught that move. And if I'm not mistaken, you could check the archives. I reversed on that date, covered shorts, went long, if I'm not mistaken. That or both of these lows. But you look, here's another reaction low right here. That was in late September. So numerous reactions. So there is another resistance level that I should have had in there, and that comes in just overhead. So, but the case I'm making here, numerous resistance levels, either in the form of Fibonacci retracements, horizontal price resistance. There's downtrend lines. I don't have everything drawn out here. Schooner had mentioned a few. Keep an eye on his charts. He does a great job of charting. I can't give that trend line any validity yet because it only has two reactions, and in my book it takes the third reaction will validate validate a trend line. So that's just a potential trend line now if we break above there, and then you'd want to watch for a reaction. So that's IBB, and let's just get back, keep this video relatively brief, get back to XBI. As I mentioned, can't recall if I just talked on this one or not, but this is the daily chart on XBI. And again, it looks like on this daily chart, that appears to be, and we'll look at the weeklies here in a second, this may be just nothing but longer term flagging action. At the very least, we have this uptrend line, and it seems to be following this ascending price channel. In other words, this uptrend line bounded on the lower end and bounded by this uptrend line on the upper end. So we're at that level. I wouldn't give that a 5 on a scale 1 to 5 as far as validity, because we only had a few tags and we've had a little reaction yet, but not enough to pull back to say this was a reaction. We could still take that out, but just something to watch. Potential resistance there, and it's kind of busy. Let's just move on to the weekly charts and then wrap this up. Okay, here's the big picture. This is really what helps drive my short-term thoughts, because at any point, just about any point in time, on any security you give to me on a single time frame, I can sit there and make a bullish or bearish case. You can make a glass half empty or glass half full case, and you read that every day. You'll read one article, somebody making a tremendous case to buy gold, and the next article you read or post, somebody's making a hell of a case to short it, and then which one is it? Because both of these guys or gals make a valid point. That's the thing about technical analysis. It's subjective. A lot of the stuff is. So what I do to help confirm my analysis on any given time frame is I always verify that, or try to verify it or refute it, looking at other time frames. And the most important thing to remember is the longer the time frame, the more significant the analysis is. In other words, if I see a breakdown on a weekly chart, a confirmed breakdown or a back test of solid resistance, and there's a breakout on, let's say, a 60-minute or daily chart, a bullish breakout, I won't take that breakout if it occurs just below significant resistance on the weekly charts, because prices are likely to reverse there. So I have to get an all clear, in other words, on the weekly charts if I'm going to take a breakout or a breakdown on a daily chart. So here we are looking at a weekly of XBI. Here's our uptrend line, very well defined, or nicely defined, I should say. At least a few reactions there. Follows this recent launch from the 2011 lows in the biotechs. And what I often talk about, it's not just price that validates a trend line, or the number of reactions, I should say. It's also how prices act off that level. And when you see impulsive moves, like when you have a support level like this, the fact that when we broke down, we had a waterfall sell-off greatly helps to validate that trend line, in my opinion, that it was indeed a well-watched level and a significant technical level. In other words, we didn't just meander down through there after breaking down, trade around, trade back through it again. We broke down. And again, this was a weekly or primary uptrend line, defining a bull market since mid-2011. I mean, the prices had actually been moving up before that, so the real bottom was back in '09. But this defines this trend. And any way you want to slice or dice it, this, indicated that primary trend was over. So is it a correction with more upside to come? Maybe. Did we go back test that? Possibly. But right now, the problem here is this resistance line. It's around 58.50-ish. We have numerous reactions. I'm talking about the white line going back here. We had that reaction high back in February of 2014, which we're now coming up to. This Fibonacci was just a validation for going long here, or covering the biotech shorts. We had a perfect retracement. You look at that from the entire bull market off the 2009 lows, which were the lows. We had a double low and a double bottom in the XBI to the highs. We kissed that 61.8 fib to the penny, it looks like, down there. So that was and that also could say, hey, maybe that's all the biotechs needed to correct. A 61.8 correction of a move is a pretty healthy correction. But in the bigger picture, there might be more to come, so we'll get into that. Nothing crazy here on the indicators. Yes, oversold. If it's an ongoing secular bull market in the biotechs, then oversold is a great time to buy. More often than not, oversold readings are very fleeting. If the primary overall trend is bullish, so that may prove to be a great buying opportunity going forward. But if this is a new bear market and the primary trend is down, oversold tends to become more oversold, or at the very least you often get a second consecutive or maybe a divergent high on another higher low, so to speak, in the RSI. Bullish cross there, but sometimes it looked like we were getting a bullish cross there and that didn't happen. I like to see divergence on the weekly chart before declaring a primary trend is over. So that's that. Let's look at the monthly on XBI. I don't have anything marked up here. In fact, XBI hasn't been trading long enough to give me really a longer term view. All right, IBB. Okay, this is what I was talking about these bear flag patterns. This is just a Fibonacci retracement again off the lows, so disregard that. I could probably even take that off. Let's do that. Just clean this thing up a little bit. So, like everything else, the bull market started back in early '09 on the biotechs, and again, this is just another biotech ETF. But this is where a well-defined trend line began. And so you can see the action. We had this wedge up here, and I believe this is where I pointed out back in 2015, the first, was it bear market pending or whatever that post video was in the biotechs, and put it on as a short trade shortly after that, LABD or LABU, I should say, and swung that down, and I think that was a 70-something% gainer, if I'm not mistaken, because of the decay and the leverage in that. And these sharp moves down really help that too, as do these consolidation ranges when you're shorting, and that's why I like to short the long version ETFs instead of buying the short version, because you get the decay. If you're swinging a primary trend down, this chop back and forth consolidation actually works in your favor if you're short a leveraged ETF instead of long. So now, you can see these two lines here, these horizontal lines. Nice. Look at the reactions right here back in early 2014. Several reactions here. We broke out. Again, you can see a large green candlestick here, validating that breakout and confirming those were well-watched levels, and that kicked off that final leg in the Biotechs. And then, boom, we broke this downtrend line, that rising wedge pattern, came, pierced through this longer-term uptrend line, got above it for a few weeks, and then the Biotechs gave up the ghost right here. You can see that huge red candlestick, formed this flagging right below the primary uptrend line. See this bearish pennant pattern, or I should say bull flag pattern, broke down below that impulsively on the breakdown, confirming this uptrend line. And now we're doing much of the same here. I should redraw these lines. Get this circle out of here. And, this is what I was talking about when you look at it on the weekly charts. It is more indicative of a flag pattern, with this being the flagpole on that move. And if we, need to break down soon, and if you look at the measurement, and you saw what I did, I just grabbed the length of the flagpole, you add that to the highest point in the flag, and look how well it comes in with my next downside target, 185.52. So, if that proves to be the case in IBB, that's talking another 35% or so downside in the biotechs, and this is one of the things. If you look down here, these divergent highs I didn't mention on XBI, this is what goes into my longer term analysis. This tells me new bear market instead of correction. Had we had these trendline breaks without such powerful clear divergences on the weekly time frame as we're looking at here, I might say, okay, the biotech's ahead of themselves, they need a healthy correction, and then they can resume their bull market. But no, as I mentioned, most often, or very often I should say, on sectors, indices, etc., key stocks, it's these multi-month or even multi-year divergences, whether they're bullish or bearish. Bearish when you're in an uptrend, bullish when you're in a downtrend or bear market, that tend to mark reversal points. We saw it in 2009. We saw it at leading up to the 2007 highs. I should say at the 2009 lows, bullish divergence. You can go on and on and on, and those tend to lead to multi-year or major corrections. Remember, bear markets happen much faster. The stocks fall much quicker than they rise. So the bear market from 07 to 09, I think was not even 18 months, but wiped out over 50% of the stock market. So. All right, let's just move on here. I don't want to beat a dead horse. Let's look at PBE, see if there's anything significant there. Oh yeah, here we go. Weekly chart on PBE. Look at this divergent highs I just mentioned. That marked, this is where I was calling at the time for at least a 24% drop. We got that in just a day there, and then some. There was a PBE has a unusually large candlestick because there was a sort of a mini crash there, and a lot of trades kind of traded well below where they should have went. So that candlestick is, I don't want to call it erroneous because there were some prints down there on PBE. But there's that flag that I pointed out. We broke down, bear flag, broke down almost perfectly. You see this line right here? That's just a measurement from the peak of prices, or in other words, from the flagpole down to the bottom of the flag, added to the top of the flag. That was a measurement. And that played out perfectly. So, a lot of these bear flags, bull flags, wedges, they don't always work out, but it never fails to amaze me how many times they do, and they work out almost perfectly, as expected as far as, this measured target here. That's what caused that. So, or that's what really, led that, indicated how low the biotechs might drop after they broke down from that flag. So what's going on now? Here's that yellow uptrend line, pretty well defined. I probably need to tweak it a little bit here. And I can, that's good enough. So we're right there. Remember, weekly charts, all that matters is the weekly close. So yes, the candlestick is a little bit above there, but it's only Wednesday, so we've got a couple days to go. And if the reversal, if the biotechs reverse in the next day or two, even if we close on that line or even a hair above it, remember you can sometimes see these wicks or these brief intraday pierces like back here, intra-week, even maybe a small close above. But the bottom line is right now we're backtesting, or in the vicinity of backtesting, this primary downtrend line after breaking below it. Add to that, look at these two horizontal lines here. You see these levels back here, that reaction low, this big fat gap right here, that is resistance as well. So even if we punch through this trend line a little bit, as we had, go a little higher, we still have horizontal price resistance, as well as these candlestick highs right here back from the week of Friday week ending January 29th and January 22nd. You can see the reaction highs there. So that's it. There's the, big picture is that it appears that there's a good shot, nothing's guaranteed, that there's another leg down to come in the biotechs. And if so, I think shorting here is objective with, stops not too far above. And I may add another LABD or LABU short and maybe some individual biotechs. Video's getting a little long, but let's just do this. Let's run into a few of the names, because I always like to do that. ETFs, or a sector, is simply a sum of its parts, and so we're going to dig into the parts right now. And I've covered the weekly charts enough on the ETF, so now let's look at some really long-term charts. And this is something we can do on the individual stocks that we can't, because a lot of ETFs don't have 10, 20, 30-year price histories. This is Gilead, one of the biggest in the industry, if not the biggest by market cap, actually. What do I see on this chart? Well, we have this long-term uptrend line that I would put good odds that at the very least we're going to revisit in the coming months. We haven't visited that trend line since back in those lows in 2011, as I mentioned, where the late 2011, where the current bear market, or leg, I should say, the lows, as I mentioned, were in 2009. We kind of went up a little bit, but then really started this super launch, this super rally, if you will, in late 2011. So my guess is we need to come back and visit that trend line. Looks like, you see these three candlesticks, that looks like flagging action to me, following these three big red candlesticks. So again, if you want to play it safe and you don't want to get ahead, especially on something that can run up 5% in a day, and I'm talking that's just the one-time ETF, the sector, then you wait for a clean break below these lines, and your entry is obviously not as favorable, but your probability is a little better there. So you can see that projects pretty much down to that flag. And if the symmetry holds true on the rough flag I just drew, then that would take us there by looks like October, end of October actually. So it'll take a while to get there if that does happen. What else is there to point out? Okay, the ROC 13. This is a good trend indicator on monthly time frames for a lot of stocks and indices. Last time we had it red for a while here was back from this point to here. Now that may not look like much. I use log scaling, so it may not appear like much of a drop on a log scale, but let's measure it out. I'm going to grab the peak of the highest candlestick there when those red lines start. I'm just going to go peak to trough here. And if I hit that right, you can look in the box in the left-hand corner, right off the bottom, it says 44.8, negative 44.8. So that's a 45% drop right there. So don't minimize the use of this trend indicator. And that's telling us right now, and it could change, but as of now, we're in a bear market according to that one trend indicator. PPO is still in positive territory. RSI hasn't still seen oversold levels in quite a while, despite the move off the top. So that's Gilead. ABBV doesn't have enough trading history, so I'll have to skip over that one. Celgene, this is a big one everybody knows. Look at this beautiful, beautiful giant rising wedge, confirmed with negative divergence on the RSI and the PPO, which is my preferred momentum indicator on the weekly time frames. There I'm circling, showing the ROC 12, flashing, the primary trend is down. Last clusters were back here, and again, I'll measure it, but I think it's about the same. I can't put it right on that candlestick because if I grab that, it'll grab the trend line, but it's about 50% bear market correction, whatever you want to call it, during that time period. And then we had this period here with ROC 12 was in negative territory all throughout this bear market, or correction, whatever you want to call it. That's about from peak to trough, a 85% drop. So so far, what have we given up on Celgene? Let's see, from the peak down to the lows, about 34%. That just doesn't jive with the previous corrections, and more importantly, the scope of this pattern. In my opinion, I wouldn't be surprised. In fact, I would expect Celgene to drop to probably that level, roughly 24.43. I know that's heresy amongst, biotech bulls, but it might take a while to get there. At the very least, we have some reactions here. This would be my minimum longer-term target if and when, of course, this uptrend line breaks. We're wedging up in the top, so it might happen soon. We could have another reaction, and we may go test the top of that wedge again and break down. But my guess is in the next year or two, there's a good shot we'll hit at least that minimum target there of 38. So the stock's at 107 now. You can do the math on that if I'm correct what that'll mean to the biotech sectors. Because again, I'm looking at the top components. So these are the most heavily weighted in those ETFs. Here's Biogen IDEC, based for several years in a sideways trading range, and then launched off the lows. Here's its bull market uptrend line. Going all the way back. Remember, we're looking at monthly charts here, so I'm going all the way back. The bull market began, as I mentioned, in late '08, early '09, but this is where the trend line is very clear, and we broke below that, so that looks like the trend is now bearish. It's certainly confirmed bearish on the ROC 12, and we're looking at a potential crossover. Keep an eye on this white line on the PPO, the 9 EMA. When that crosses, that signals bear market territory. As you can see here, Biogen was the last true bear market, or secular bear market, was back all the way leading into 1995, and you can see the PPO well above there. And look how well it's stayed above since. We had some, technically they were bear markets because they were over 20%, but for the most part, that's just been a sideways trading range. So another one with what I consider a longer-term bearish outlook. REGN, Regeneron, there it is. I mean, what else to say? Here's a steep, and that's the thing that you have to really take into consideration. When you have rising wedges or trend lines, the steeper the trend line or the pattern, the more severe the correction, the downside reaction. I'm not going to equate it exactly with the tech bubble in 2000, but it's damn close to it. I'll tell you, everybody has just been goo gaga over these biotech stocks, and they're still, look at it, it's had a heck of a correction, but it's still kicking a 73% PE ratio. These things have a lot of air left to come out of them, to come back down to reasonable valuations. So there's a support level around 348 horizontal that needs to go, but we've already broken down from this wedge, and talk about measuring out patterns and things. With a rising wedge, you just take a general rule of thumb is you take the steepest point of the wedge, the longest distance, and that would be here at the beginning of the wedge from top to bottom, and then you add that to where prices break down. So that tells you this one has, and I see a nice reaction there too. So over time, I would expect, again, if the sector takes a leg lower, that one's probably heading down to about the 190 level, and so that would chop the stock in half from where it's at now, more than half. Our ROC 13, clearly indicating this uber bull market is now over. Then again, maybe a correction. I don't think so. That's just my opinion. And finally, and we'll leave it here. I could sit here and go through every one of these stocks. The story is going to be the same. This isn't weekly. This is monthly divergence. And for those of you new to trading, or at least new to listening to my commentary, from my experience, the same chart patterns, divergences that you draw on a 5-minute chart, 60-minute chart, daily chart, play out just as well out on the weekly and monthly time frames. So the only difference is a monthly chart, the scope of this pattern, the duration is so much longer and farther. This was a multi-year pattern. So if this wedge plays out, you're not trading 2-3 week swing trades when you're looking at the monthly chart. You're positioning for a trend that's going to last months, possibly years. So that's my take on these now. And again, sometimes the charts change. Sometimes these divergences get burned through. So first things first, and we watch those daily charts. We watch those 60-minute charts and all those levels that I discussed. one by one, if and as they're taken out to the upside, that chips away at this bearish case. And in hindsight, a few months from now, we could be looking at the biotechs doing another video, and I acknowledge that this was just a correction. But again, it's not as if I'm going to be short all the way up here if any positions that I have now. Like I said, there's a little work to be done, especially downside break through those bear flags on the weekly charts, break of the recent lows in the biotechs to help confirm the case. All right, this video has gone on long enough. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.